Afternoon again. I'm certain amount of new concepts in economics, and we are going to discuss one of the most important topics that again has been one of the favorite topics of UPSC as well. That's called capital adequacy ratio, or what we call as capital to risk weighted asset ratio. So before that, we dive into this, we have to understand what's the Basel norms, how bank functions, what are the certain vulnerabilities of bank, what are the certain insecurities of bank out there. We need to understand that. Once we got into that, then we'll realize what's the importance of capital adequacy ratio, or CRAR, that is capital to risk weighted asset ratio. I'm going to explain this in a very simple language, very simple language. So you get what it is. It's one of the most complex topics out there, but trust me, once you see this, you understand that no one can teach that better. Sorry, it's just flex about that. Okay, let's carry on this. Let's carry on this. How certain things function, how banks function out there. Let's go on this. So let me tell you one thing. Let me tell you one thing. Let me tell you one thing. Banking is a very, very extremely risky business. Extremely risky business. What if bank lends certain money and no one pays that? That actually calls non-performing asset out there. That actually calls non-performing asset out there. If you don't pay interest or principal amount within 90 days, that's called non-performing asset. And that what really happened in 2008 financial crisis as well. But we are into this. We are into public sector banks. We are into scheduled commercial banks that operate in India. So let's carry out. Let's well into this topic. Okay. First of all, sir. First of all, banking is an extremely banking is an extremely vulnerable business, risky business. If I call banking, it's a business. It's a business of lending and taking rate of interest out of that. It's a risky one out there. It's a risky one. It's a risky business. What's the major threat for that? What's the major threat? Again, sir, the major threats are non-performing assets. The major threat is non-performing asset. What if the borrower was what if borrower won't able to pay that interest and principal amount? He become insolvent out there. That's the risk of a bank. That's the risk of a bank. That's called non-performing asset for bank. Non-performing asset for bank. That's called non-performing asset. That's called non-asset. Okay, that's risky business. That's called non-performing asset out there. Now, in order to counter that, in order to safeguard banks from any sort of vulnerabilities or any sort of risk, Basel norms came out. It's an international standardization. Basel norms came out. The first Basel norm came out in 1988. The first Basel norm. The first Basel norm came out in 1980. In 19. First Basel norm came out in 19. But that's not important for us. What's the objective of this Basel norm? The objective of the protect any sort of bank from any sort of bankruptcy. That's the primary motive out there. That's to secure bank against these uninsured or collateral-less securities or collateral-less loans that it distributed out there. That's what basic meaning of Basel norms that come out in 1988. But sir, we are not here to discuss Basel norm 1. Again, there are 3 Basel norms, 1, 2, and 3. But the major focus lies in the Basel norm 3. Basel norm 3. Basel norm 3. Basel norm 3 that came out in 2010 after sir 2008 financial crisis, aftermath of 2008 financial crisis. 2008 financial financial. What's this? What's this? Sir, it came out with a concept called capital adequacy. Banks need to ensure the adequate capital adequacy ratio that makes them feel secure. That's obviously provide them a cushion out there that doesn't let them to face those vulnerabilities of non-performing asset or default borrower out there. In order to make them feel safe, in order to make them feel provide a cushion, capital adequacy ratio come out. Now, what's that? That's the major important aspect of this, because the question has been asked over and over again by the UPSC, and it's one of the favorite topics of UPSC out there. So let's well into this. What's a capital adequacy? Called capital adequacy. I'm going to teach this concept in a bit of length because it's important. Capital adequacy ratio, aftermath of 2008 financial crisis. Capital. Or you can always also call that RAR. RAR. That is capital to risk weighted asset ratio. Risk weighted asset ratio. Or risk weighted asset. Risk weighted asset. Example how this works. Take an hypothetical example of bank one. Take example of bank one. Bank one. Example of bank. I'm going to prepare a balance sheet for these two banks. Prepare balance sheet. Act balance sheet for banks. How balance sheet look like? Simple. That complex. Assets and liability. Again, for this bank is called assets and liability. We're going to compare these two banks. Asset and so suppose one thing in economics, that entity and owner are different entities altogether. For example, if owner of a certain company, that doesn't mean if I am the owner of a certain company, it doesn't mean my money pull into that company's money. No, companies different. My own personal profit is different. You must have heard the term called drawings. Then the owners draw certain amount of money from their organization. That's not their money. That's shareholders' money. That's company's money. Owner and company both are different entities out there in accounting terms. They are not one. They are not one. Even some co-founders extract salary out of that. Even some co-founders extract salary out of that. It does not mean that owners have a whole group of these owners have a whole sort of cash that's available companies there. No, it's not like that. It's completely false argument out there. Both are different entities and both should be treated in different entities as per the accountancy that's been practiced in India. As per the accountancy that's been practiced in India. I hope you got this. I hope you got this. Okay. So let's carry on this. Let's carry on to this. Let's carry on to this. For example, if owner's capital, that is promoter, owner's capital, that's a liability for a company. Why? Because company has to repay that. It's an asset in the accounts of owner, but a liability in the accounts of company. For example, owner's capital is 1 crore. Capital is equal to 1 crore. 1 crore. That's a liability of. Again, deposits of public. Deposits of public. Deposit of public. It's an asset for a public because they're going to get this. That's their investment. But it's a liability for a bank because at certain moment of time, they have to repay that to the public. They have to repay that to the public. That's called liability aspect. And when I talk about the public deposits out there, when I talk about the public deposits, it's nothing but a liability for a bank. Public deposits. Public deposits, it's a liability for a bank. Suppose it's 3 crore. Suppose it's 3 crore. Now, so what happens? This bank, this particular bank this particular bank will lend, because that's a primary function of banking out there. That's lending out there to earn money out of interest. That's the main function of bank. They're going to lend this money. They're going to lend this money. But in this case, the personal loan, they're going to lend to personal loan. Personal loan. Just personal loan. That is 1 crore. That is 1 crore. Personal loan. Must have heard that Vijay sort of guy or all these. They got those personal loans. That's loan without any collateral out. The loan without any collateral out there. And it's a risky one. It's a risky loan. Then housing loan. Further, they give housing loan on collateral. On collateral. Collateral. That is 3 crore. That is 3 crore out there. Total 4 CR. Total 4 CR out there. That's the balance sheet, how it looks like for a bank one. Don't jump into the, observe this. This is certain accountancy term that needs to be addressed. This is the accountancy. That's a book for bank one. That's a book for bank. For that's a book. Cool. Now let me come to the bank two. Come to bank two. Again, take owner's capital. Owner's capital. Owner's capital. 1 CR. But depositors' money is 3 CR. Same liability side will remain the constant. Okay. Depositors' money. Public deposit. Money is 3 CR. But in this case, the personal loan, it offers personal loan that is without any collateral. That's a risky one. That's insecure loan out there. That's what we call giving a loan out of favors, nepotism or what sort of thing, all these stuff. That's personal loan. Reference game. Personal loan. Personal loan is nothing but 3 CR. In this bank, it was 1 CR. In this bank, it is 3 CR. And collateral loan, any sort of collateral loan, is nothing but 1 CR. Is 1 CR. Got this? You got this? I hope you got this. Now compare these two banks, sir. Now compare these two banks. You will get this, what these banks are offering. Bank one is playing it more risky. Is playing it more risky, or bank two is playing it more? Bank two is playing more risky because sir, it's offering personal loan for, that's 3 crore amount out of total 4 crore, out of total 4 CR. This bank is lending 3 CR for personal loan. That's to secured loan without any collateral security out there, without the collateral security out there. But this bank is playing, and it's playing smartly as well, because it just offers 1 CR to personal loan and 3 CR against collateral. That's a smart way of doing banking, because you want to remain secured. You don't want to create that twin balance sheet problem out there, or non-performing assets out there. What's these things? I'm gonna explain that, but again, not going against this concept. This has to be there. You have to consider that, otherwise everything will be just good. I'll explain that what's twin balance sheet problem out there, or triple balance sheet problem out there, or asset liability mismatch that's been taken with DL and IFS, all these NBFCs. I'm going to explain that, but you need to show some sort of patience out there. You need to show some sort of patience out there. These two are banks. Compare that. This is playing better. This is playing more risky. If in future, if by any chance this become defaulter in, it's become, these persons become defaulter in this case, or become insolvent, or were unable to pay their interest out of debt, that become a non-performing asset, and this will be done and dusted. that bank will be doomed. Again, because it doesn't have any asset, it has to sold its assets to another third party, or has to sold it equity, another bad loans to another banking sector. That's not a great situation, because that's very risky out there. So it's playing risky, it's playing safe. Now you have to calculate the capital adequacy for these two banks. And you don't need to calculate that. It's a very basic out there. You need to understand these two balance sheet and look, bank one is playing safe. It's a better bank out there. If I want to invest in certain bank one or bank two, I'm going to invest in bank one because it's a much secured thing. I'm going to get my money back. What if this bank two collapses? I'm gone. My money is gone because the security is only of 5 lakh. What if I deposit 10 lakh? My 5 lakh is gone. I'm only get 5 lakh out of that 10 lakh. Security, the insurance is just 5 lakh as per the law. Okay. So I'm going to invest my money in this bank one, not in bank two. How you calculate capital adequacy ratio? How you calculate capital adequacy ratio in mathematical terms? It's risk weighted. It's risk weighted. How capital adequacy ratio is calculated? How capital adequacy? It's risk weighted thing. It's a risk weighted thing. For example, you must have studied that weighted average thing. Weighted average thing in your a lot weightages calculate a lot weightages. In this case, sir, I'm gonna allot weight. I'm gonna allot weight for housing against collateral. I'm gonna allot weight of one. It's a secure thing. I'm gonna allot a weight of 1. In personal loan, I'm gonna allot weight of 0.5 weightage, because it's a security one. A lot less weight to this and more weight to this. Now let's calculate. Calculate for bank one and bank two. For bank one, and for bank two. For bank one and bank two, how are you going to calculate that? First of all, it's promoters capital, promoters capital, promoters capital to risk weighted assets, risk weighted loans, risk weighted loans, risk weighted loans, risk weighted. The formula out there. Now let me calculate for bank one and bank. Let me calculate for this bank one and one. B2. Promoter's money was 1 crore. Of course, the promoter put out the paid up capital as 1 crore. That will be 1. Upon risk weighted asset ratio. In case of bank one, look at this. In case of bank one, it has provided 1 CR personal loan with a weight of 0.5. With a weight of 0.5. So 1 into 0.5 plus 3. That's 3 is a loan against collateral against a weight of 1. Against a weight of 1. In bank 2, again, numerator will be same, that's 1. But the scenario will differ. In this case, 1 will be offered. 1 will be offered with 1 because it just offers. Bank 2 is more riskier. It's just offering 1 crore off. It's offering 1 crore against the loan against collateral. And it's offering 3 crore. That's unsecured loan with a weight of 0. With a weight of 0. Let me calculate for this you. Let me calculate this for you, sorry. 1. That's 0.5 into 3. 0.5 and 3. 5. That will be 1.5. That will be 2. Bank 2. This will be approx 0.4. This will be approx 0.3. Approx 0.4. This will be approx 0. Now, after understanding all this example that I have shown to you, you need to come out with a conclusion and a solid conclusion for that. And a solid conclusion for that. What's that? What's that? Sir, as your capital adequacy ratio is higher, your bank is much safer. Your bank is playing prudently, or I would say rationally out there. So higher the capital adequacy ratio, higher the chances that bank is safe. It's not gonna default. It's not gonna become bankrupt out there. It will remain positive. It will secure your deposits. It will secure general public deposit in a much efficient and effective manner. In a much efficient and effective manner. I hope you got this. I hope you got this. All of this. So we come out of the conclusion that higher the capital adequacy ratio, higher the capital adequacy ratio, higher the capital adequacy ratio, higher the chances that bank will perform. Higher the chances that bank is operating well. Higher the chances bank is bank bank is operating well. Is operating well. So this is the conclusion. This is the conclusion. You need to remember this statement. You need to remember this statement. There is other no way, because that's one of the most important, one of the most, it's been, you can sincerely look at the PYQ. I think 20, this statement directly asked. Statement has been directly asked. If you don't know the concept, trust me, you will suffer in this. You will suffer in this, and especially in the economy section. For example, if you're good in rote learning, survive environment, and not good with not good with not good with your imagination out there, suffer heavily. And if you're gonna suffer in economy, trust me, not clear. That's the hard words out there, but that's reality out there. Because economy, on an average, it's been 14 to 15. That's been asked. And again, GS3 is there. One is being several out there, Asian economy, all the stuff. GS4 is there, stays there. Trust me, just just listen to this. Have a hold over this. It's the least amount to prepare this subject once it's basic. That's for sure. That's for sure. Okay, that's for sure. That's for sure. Hope you got. I hope you got this point. Hope you got this point. Let me revise this again for you. Revise this again because it's one out there. One of the most important topics out there. Let's see what it happens. Let's see how. Let's see how it impacts. So we have heard that Basel norms come out, especially Basel norm third that came out aftermath of what 2008 financial crisis. What's the reason? Because banks has been suffering a lot. The management was opaque. Nothing was going as per the standards that's right to them. A lot of corruption was there. A lot of lenient lending was there without any collateral or all these stuff. In order to safeguard banks from all these stuff and all these mismanagement, came out in 1998. But the Basel norm third, that's important aspect of these, came out in 2010 after 2008 financial crisis. What's the Basel norm? It prescribes that a capital adequacy ratio a minimum capital adequacy ratio need to be maintained. What's a capital adequacy ratio? It's nothing. It's just higher up capital needs to be there as a cushion. Higher up capital needs to be there as a just cushion to just help them to survive in this very, very uncertain business of lending. Survive in this uncertain lending business. What's this? For example, there is Bank 1 and Bank 2. Get the balance sheet out there. Liabilities and Bank 2 is playing more safer because it's offering personal loan of 1 crore, only 1 crore. But this bank is playing riskier because it's offering personal loan of 3 crore. Personal loan means against without any collateral security. So by looking at these, you can sincerely come out to the conclusion that Bank 1 is performing well. If I have to invest my money, where would I invest? I will invest in Bank 1 because it's a secured bank. It's not. What if this personal loan members default by nature? What if it turns out to be a non-performing asset for this bank? Gone. Money will be gone because it will become a bankrupt out there, insolvent out there. Okay, so all these stuff you need to understand that okay, Bank 1 is playing safe, Bank 2 is playing riskier, Bank 1 is more secured. If I'm going to invest my money out there, I'm going to invest that in Bank 1, not in Bank 2. because there has been a cushion, it's been operating on a standardized formula out there. Now, capital adequacy ratio or risk-weighted asset ratio, what's that? It's nothing. It's been calculated by promoter's capital by risk-weighted alone. What's risk-weighted? Of course, you must have studied that weighted average out there. You need to allot weights to certain things. That's how you calculate weights. So I'm offering a 0.5 to less weight to riskier loans and 1 to more healthier loans. I'm calculating promoters money. Of course, numerator will be same 1 1. 1 into 0.5 plus 3 into 1. That's 3.5 and 2.5. For bank 1, it's coming out 0.4. For bank 2, it's 0.3. You know by looking at the balance sheet that bank 1 is a much safe option as compared to bank 2. And it's showing exactly same. What it's showing? The higher the capital adequacy ratio, more safer is the bank. More predominantly playing along with the standardized rules. It's keeping that your deposits secured as compared to the bank that's been playing riskier. Okay, so higher the capital ratio, more safer is the bank out there. That's what a capital adequacy ratio is. That's what a capital adequacy ratio is all about. I hope you got this point. I hope you got this point. Now, sir, there are certain other things like let's come to the Basel Basel Accords. Of course, what's Basel Accords? That's nothing but norm standardization that's been prescribed by the international bank out there. Nothing. Don't worry about that. Capital adequacy ratio measures bank capital against risk-weighted assets. Risk-weighted assets. Risk-weighted assets. This is the term that you need to risk-weighted assets. For example, the risk that weights that assigned to the more riskier loans is less as compared to the weight assigned to the more secured loan. That's a risk-weighted asset because again there are high chances that they may default by nature, will become a non-performing asset. Again, post 2008 crisis, Basel III norms came out. Minimum requirement is 8% capital adequacy ratio. But again, for Indian scheduled banks, it's 9%. For public sector banks, it's 11%. Public sector banks, it's 11%. 11% of a total paid up capital and 9% of a total paid up capital. Total paid up capital is amount that's been deposited by the owners of the bank. That's what it is. That's what it is. The minimum prescribed capital adequacy ratio for scheduled bank is 9%. It's 9% that needs to be created as a buffer that will not be spent on a lending purposes. It will be just act as a cushion. And for public sector banks, it's 11% out there. And for public sector bank, it's 11% out. So if you're looking that, you need to come out of the conclusion that higher the capital adequacy ratio, higher the chances that bank is operating well as per the prescribed standards out there by the Basel Academy, by the Basel norms and Basel Academy. I hope you got this. But again, let me give you a certain statistics for that. So for capital adequacy ratio, the minimum requirement is 9%, 9% for scheduled commercial banks and 11% for public sector banks. That's the prescribed nature. That's been allotted by RBI. You need to remember these facts out there because that's been asked repeatedly by the UPSC in the prelims exam as well as in. So this is the most important topic that I want to explain, and I've explained that in a holistic manner out there. I hope you got this. Let me give you another example for this. So for example, if bank is not performing well, and it's out of there, it's on a situation of a dire out, wants to just collapse, it's just collapsing out there or become a part of that non-capital or non-performing asset out there. What government does, it offers recapitalization bonds to rebound its public sector bank. Recapitalization bonds. Capitalization. What is this? Oh, sir, a bank is not performing well. Funds out there, facing crunch out there. What will government do? Of course, government will certain amount back. It will issue, and of course, in return for bonds, bank will repay certain amount of money to the government. Government in return again will invest this money in a bank to revamp its functioning. That's what called a recapitalization. That's what called a recapitalization. So suppose there is a government. Suppose there is a government. There's some PSB, Public Sector Bank One. This Public Sector Bank One is facing a shortage of funds out there. It doesn't have that much of funds left. It's on a dire need. It's on a verge of collapsing. So what does the government do? Government will say, okay, let me issue certain bonds to you. Let me issue certain bonds to you. In return of that bank, PSB, PS will lease funds to purchase these bonds. These funds to raise that bonds. Government will get these funds. Now it's a primary duty of government to revamp its PSP functioning because a lot of trust has been positioned on PSP. It's like too big to fail concept out there. PSP can't die out there, otherwise the whole economy will collapse because a lot of people invest certain amount of money in lending or deposit purposes as saving account or FD in PSP. The government will what will it do? It will again reinvest these funds in PSP to revamp its functioning, to revamp its function. To revamp its function. What's the primary functioning of PSP? Primary function is earned rate of interest. Primary function of bank out there. It's a riskier one because again there's a problem of a non-performing asset house, non-performing asset as well. And again, it consider that because it's been doing well. It's been doing well. These philosophies and economies of government and these policies are pretty much doing well. You remember that there has been a collapse of Yes Bank out there, and collapse of Indus India. Its share fell by 27% in a single day due to hedging out there, due to hedging, internal hedging fraud out there, and it's you just resigned from that bank recently. So I hope you got all of this concept. I hope I've spent enough time out there. I hope you got this. I hope you got this balance sheet out there, assets liability for Bank 1 and Bank 2. Again, I'm going to explain this in a bit of manner. Bank 1 is a pretty risky, it's a safer bank out there because personal loan is just 1 crore. Whereas Bank 2, it's playing more riskier because personal loan is 3 crore. Personal loans mean there has no collateral. There is no collateral out there. It's been given out of certain references. Again, Bank 1 is playing safe. If I have to invest my money, where I'm going to invest that? Not in Bank 2, sir, in Bank 1 because it's playing safe. It's playing as per the standards prescribed by the Basel norms 2010. Basel norm 2010. From this, you can calculate, of course, what we called capital adequacy ratio. That's promoters capital by risk weighted loan. So for Bank 1, numerator gonna remain same, 1 and 1. For denominator, I'm gonna assign 0.5 value to more riskier loan and 1 to more safer loan. Of course, Bank 1 will be calculated 1 by 3.5 and Bank 2 will be 1.25. Approx 0.4, 0.3. You came out of the conclusion that Bank 1 is safer by looking at its balance sheet. We came out of the conclusion that if capital adequacy ratio is higher, bank will be much safer. Bank will be much safer out there. You need to invest that money out there. I hope you got this. I hope you got this. Let's go on to the PPT out there. Okay. Again, this Basel III norms post 2008 crisis strengthen capital, liquidity, and leverage. Leverage meaning is risk. Meaning of leverage is risk. Risk associated with lending. Risk associated with lending purposes. Okay. Again, the minimum requirement, what I said, as per the RBI, the minimum requirement is 9% for the scheduled commercial bank and 11% for the public sector banks out there. Okay, let's go on to the next slide. Liquidity crisis, I'm going to explain in next class. This is interplay of Basel liquidity and money supply. Interplay of Basel liquidity and money supply. What's this, sir? What's this? Again, sir, what I've concluded out of that whole explanation, that higher CSR restrict excessive bank lending, moderating money supply. Again, you need to understand, because in my previous lectures I've explained what's money supply is. If you don't know, please go to the previous lecture, search for it. You're gonna get. If there will be higher CSR, Means that banks need to save more money out there. Banks need to save more money out there. There will be less lending in the market. Less lending in the market will eventually lowers down the money supply in the market. Will eventually lowers down the money supply in the market. That's the whole idea out there. That higher CAR, restrict excessive bank lending, moderating money supply. Moderating money supply. Again, central bank, RBI operations influence bank reserves and broader money supply. RBI, of course, once it's a part of fractional reserve banking. What I've taught earlier as well, it's a part of fractional reserve banking. Higher the reserves, less will be the lending. Less will be the lending, less will be the inflation out there. It will help to control hyperinflation out there in the economy, or it's one of the monetary tools for the RBI circulate or to manage economy better as compared to what was happening earlier. What was happening earlier. That's one of the interplays. So I hope you got this point. I hope you got this point. Insolvency bankruptcy code. This is again one of the most important topics out there. I have to explain this to you. I have to explain this to you, but not in this class because itself is a 1 hour topic out there. I'm going to explain this to probably in next lecture out there. So I hope you got this. I hope you got all of this stuff out there. I hope you got all of this stuff out there. Capital adequacy ratio. Please get hold over this topic. It's one of the most important topics out there. Being repeatedly asked. It's a favorite topic of UPSC out there. So I hope you get this. I've explained this in a wholehearted manner. No one would have explained this. So just trust me and just revise this. It's gonna be a life changing. Simply, most can't deny the fact it's being asked. Similarly, what's being taught to over here. So thanks for this. Thanks for this. Happy learning.